Welcome. Today we're doing a deep dive into the Fiscal second quarter 2025 earnings call from Mission Produce.
That's right.
We'll be digging into the results, the strategies they discussed, and what they're signaling for the future.
And the overall feel from the call was, I'd say, pretty positive, wouldn't you? Especially looking ahead.
Definitely. It paints a picture of a company navigating some interesting market dynamics, but really executing on their plans.
Yeah, you see that record revenue number, but the story underneath is about how they manage challenges like avocado margins early on and how those diversification bets are starting to work.
Exactly. It's about the levers they pulled. So let's start with that snapshot, the headline numbers for Q2.
Okay, so for fiscal Q2 2025, they hit a record revenue number, $380.3 million.
Wow.
Yeah, but that's up 28% compared to the same time last year. Big jump.
A 28% increase is definitely significant. Yeah. But looking a bit further down the P&L, adjusted EBITDA was $19.1 million.
Right, which was actually slightly down from $20.2 million last year.
Okay, and adjusted net income followed that trend.
It did, $8.7 million, or 0.12 cents per share, compared to $9.8 million, or 0.14 cents last year.
So, record revenue, but profitability slightly lower year over year. What's the main reason for that divergence?
It really boils down to gross profit. It was $28.4 million this quarter, down from $31 million. And the main driver there was lower per unit avocado margins. Particularly early in the quarter. They did stress that things improved as the quarter went on, which is, an important detail.
Right. So strong top line from price and maybe volume, but some pressure on the profit per avocado, at least initially. Got it.
Mm-hmm.
So let's dig deeper then. How did they get that record revenue? What were the dynamics?
Well, that big 28% revenue lift wasn't just volume. A huge piece, 26% of that growth, came from higher selling prices per avocado.
Okay.
And they tied this directly to strong consumer demand. What's really interesting is that retailers could pass on those higher prices without seeing volumes drop off a cliff. That really reinforces, in their view, how durable avocado demand is in the U.S. Maybe less of a luxury, more of a staple now for many.
That's a key takeaway. Demand elasticity is lower than maybe feared, but avocados mean dealing with supply, especially from Mexico. How did they handle the seasonal shifts there?
Yeah, this is where their global sourcing network really shines. It's a core strength. They navigated the usual sort of seasonal Mexican dynamics by tapping into that network.
Yeah.
Meaning when things got tight or tricky in Mexico, they could pivot. They brought in fruit from California, from Peru, gave them flexibility.
So it's not just having other sources, it's the ability to actually use them effectively when needed.
Exactly. Deep grower relationships, logistics, it all plays a part.
Okay, let's break it down by segment then. How did the main marketing and distribution segment perform? That's the biggest piece, right?
It is. Net sales, they were up 26% to $362.5 million, almost perfectly matching the overall revenue growth driven by those avocado prices we talked about.
Makes sense.
But segment adjusted EBITDA was lower. $16.8 million versus $21.7 million last year.
And that's where we see the impact of those lower per unit margins we mentioned earlier.
That's exactly it. Lower per unit gross profit on the avocado sold. Management said this was pretty much in line with what they expected, though.
So not a surprise to them.
Apparently not. They also called out about $2.6 million in, let's call them unique costs, hitting that segment.
Like what?
$1.5 million for closing down some Canadian facilities, and another $1.1 million from some unexpected tariffs that popped up for a few days in March on goods coming from Mexico.
Okay.
If you strip those specific items out, they said the per unit margins looked much closer to the historical average.
Gotcha. So some expected margin pressure plus a couple of one-offs. That clarifies things. Now, international farming, that segment had a pretty big turnaround.
It really did. Huge improvement year over year. Net sales climbed to $8.1 million. And the big story, adjusted EBITDA flipped positive.
Positive from what?
From negative $2.2 million last year to positive $1.5 million this year.
Wow, that's a swing of almost $4 million. What drove that?
Mostly two things. Better yield and pricing from their own mango orchards, plus more activity in their blueberry packing and cooling services. They see this as real validation of their diversification strategy. These other areas can actually contribute, even in a typically slower farming quarter.
Yeah, helps balance things out. And what about the dedicated blueberry segment?
Blueberries saw sales jump 57% to $15.7 million. Big increase.
Okay, driven by?
Higher volumes from their own farms, they've got more acres planted, and yields were up.
But profitability?
Segment-adjusted EBITDA was basically flat compared to last year.
Huh. So selling a lot more blueberries, but the profit from the segment didn't really grow.
Correct. Lower per unit margins on the blueberries this quarter essentially canceled out the benefit of selling more volume. Margin pressure there, too.
Okay. Interesting mix across the segments. Beyond the numbers, they talked a lot about strategic expansion, diversification. Where are they seeing successes?
Well, in the UK, they mentioned continued gains, better use of their distribution center there, more customers coming on board thanks to their ripening capabilities. So that investment seems to be working.
Good.
But the really big story they hammered home was mangoes.
Right. Mango's got a lot of airtime. What's the deal there?
Just huge growth, record volumes for Mission this quarter. And that translated into major market share gains in the U.S.
How major?
They went from under 5% share to now closer to 10%. That makes them the #2 mango distributor in the U.S. now.
Doubling market share. That's fast.
It is. Very fast.
How did they pull that off? What's the advantage?
They laid out 3 things. 1, cross-selling, using those deep retail relationships they built with avocados to push mangoes.
And leverage the existing network.
Exactly. 2, becoming a reliable year-round program supplier, offering consistency in sourcing and quality, which isn't easy in mangoes.
Like they did with avocados early on.
Precisely. And 3rd, using their national footprint, the ripening centers, distribution that they already had for avocados. They basically said, we're running the avocado playbook on mangoes.
Makes perfect sense. Use the infrastructure, use the relationships, and they're still pushing on blueberries too.
Oh yeah, they've got over 550 hectares planted now, and they plan to add another 200 plus hectares, focusing on premium varieties for next season.
Leaning into that healthy snacking trend.
Absolutely. They see blueberries, mangoes, avocados fitting together for the consumer.
Okay, let's pivot a bit. Financial health, balance sheet, cash flow. How's that looking?
They ended the quarter with $36.7 million in cash. Solid number. But cash flow from operations year to date is interesting.
How's that?
They actually used $13 million in cash from operations so far this fiscal year. Compare that to the same period last year when they generated $12.9 million. So a noticeable swing.
A nearly $26 million swing from providing cash to using cash. Why the change?
Mainly working capital growth. 2 big factors. Higher accounts receivable because avocado prices were high. Customers owe them more money temporarily.
Right, that makes sense.
And second, a seasonal inventory build, particularly in international farming, getting ready for the big harvest in the second half of the year, investing in the upcoming crop, essentially.
So cash tied up in receivables due to high prices and building inventory for the next harvest. They said this is typical for the first half.
Yes, they stressed that working capital usually peaks now. Management expects a, quote, meaningful step up in cash generation in the second half as receivables come in and that inventory gets sold.
Okay, that context is important. What about capital expenditures? Investing in the business?
Year to date, CapEx was $28 million, mostly farming investments in Latin America, finishing a new pack house in Guatemala.
And the plan for the full year?
Still guiding $50 to $55 million. But the key message was that CapEx is expected to moderate going forward through fiscal 2026.
So spending less on big projects in the near future.
That's the plan. And that declining CapEx, combined with the expected cash generation ramp up, is what should position them for, meaningful free cash flow down the road.
Less cash going out on investments, more cash coming in from operations. Classic path to free cash flow. Did they mention share buybacks?
They did. Opportunistically bought back $5.2 million worth of shares in Q2.
Okay.
And they still have about $14 million left on their authorization. Management basically framed it as, we think our stock is undervalued. It's a signal.
Management putting capital behind that belief. Okay, let's look ahead. Investor context. What's the outlook for the second half? What signals are they sending?
The outlook sounds quite positive. The biggest driver is their own avocado crop in Peru.
What about it?
After being hit hard by weather last year, they're expecting a much more normal harvest this season. And normal means a huge jump.
How huge?
They're forecasting a 150% increase in production from their own farms in Peru, like 100 to 110 million pounds this season versus only 43 million last season.
Wow, 150% increase from their own farms. That's a massive recovery. That's their high-margin fruit coming back online.
Exactly. That's the key.
How does that much volume hitting the market affect things overall, say, in Q3?
Well, for Q3, they see total industry volume increasing maybe 10-15% year over year, largely thanks to that strong Peruvian harvest across all growers.
Okay.
And with that much more fruit available, they expect pricing per unit to be lower year over year, also by about 10-15%.
Compared to what last year?
Compared to around $1.84 pound average in Q3 last year. So more supply, lower prices, basic economics.
More avocados, cheaper avocados than last summer. Got it. Any word on tariffs? Always a moving target.
Yeah, they said it's fluid, but their forecast assumes current tariffs stay put. Management feels the industry has mostly adjusted, and they believe the expected increase in overall supply and the more moderate pricing will likely overshadow any big tariff impact on consumers anyway. Supply seems to be the bigger factor right now.
Sounds like tariffs aren't top of mind concern given the volume picture. They also mentioned handling supply issues earlier in the year. From Mexico.
Yes. They acknowledged it was a bit tough securing the Mexican fruit they wanted early in Q2.
How'd they cope?
Pivoted quickly. Leveraged that early Peruvian fruit, used California supply. That flexibility let them get back to using their own pack houses more normally by mid-March instead of relying heavily on third-party packers.
The SEACers, as they sometimes call them.
Right. And looking ahead, they plan to actually add capacity to their own pack houses in Mexico.
To reduce reliance on third parties in the future.
Exactly. More control, less vulnerability to those kinds of constraints.
Smart. So, wrapping up the outlook, what are the long-term growth stories they're highlighting?
Still pointing squarely at mangoes and blueberries. For mangoes, it's about getting more from their Peru ranch as it matures, but also building supply relationships elsewhere for year-round consistency.
Expanding the network.
Yep. And for blueberries, it's continuing that acreage expansion, especially with those premium varieties, to ride that healthy eating wave, still applying that avocado model.
It really does feel like the core strategy is leverage the avocado machine, the infrastructure, the know-how, the customer list to push into these related categories.
That sums it up pretty well. Diversify risk, add revenue streams using the platform they already built, makes them less dependent on just the ups and downs of the avocado market alone.
Okay, great overview. Now let's get to our not financial advice segment. Purely speculative ideas, thought experiments based on the call, not recommendations. What's an audacious but maybe plausible trade idea someone might kick around after hearing this?
All right, purely theoretical hat on. That 150% increase in owned Peruvian production, that's the big one coming in the second half, high margin fruit.
The owned farm recovery, yeah.
So one aggressive idea, maybe a bullish option strategy. You could look at buying some out-of-the-money call options, maybe expiring late this calendar year.
And betting on what?
Betting that the market hasn't fully baked in just how much that owned volume recovery could boost margins, profits, and especially cash flow in the second half. It's a leveraged bet that this specific catalyst is currently underestimated. High risk, high potential reward, obviously.
Interesting. A bet on the owned Peru volume being a positive surprise. Anything else?
Another angle, again, purely for discussion, not advice, could be a pairs trade.
Meaning?
Go long Mission Produce and short a competitor, maybe another produce company, or one more purely focused on avocados that hasn't shown the same success diversifying.
What's the logic there?
The thesis would be that Mission's proven ability to use its platform for mangoes and blueberries, plus that incoming owned Peru harvest, gives them a competitive edge, better execution maybe, leading to relative outperformance versus peers who are less diversified or don't have those owned high margin assets coming online. A bet on their strategy creating relative value.
A relative value play. Mission versus the field, betting on their diversification and owned assets. Again, folks, these are just thought experiments based on the call.
Yeah.
Not recommendations.
Yeah.
Please, do your own research.
Absolutely. Cannot stress that enough. Just illustrating possibilities based on the company's own commentary.
So let's recap this deep dive on Mission Produce's Q2. Record revenue, driven by strong pricing, offset somewhat by margin pressures early on and some unique costs. But a strong strategic story. Success in the UK, big gains in mangoes, ongoing blueberry expansion.
And the big flashing signal for the future. That massive recovery expected in their own Peruvian avocado harvest.
Right, setting the stage for potentially higher volumes, and critically, that expected significant step up in cash generation in the second half.
It really highlighted how they're using their core avocado strengths to branch out, manage volatility, and setting up for what looks like a strong back half of the year based on their own farm output.
Okay, and just to reiterate, everything we discussed today comes directly from the company's earnings call materials. It is absolutely not financial advice or a recommendation to buy or sell anything.
We're just aiming to give you the context and key points from the source so you can form your own view.
So as you think about this, consider that avocado playbook, leveraging infrastructure and relationships for new categories. We saw it with mangoes, with blueberries. What other produce categories might fit that model? And, is there a limit? How far can they stretch that operational focus before it gets maybe too thin?
That's the interesting long-term question, isn't it? Where does that model hit its ceiling, if anywhere?
Indeed. Thanks for joining us on this deep dive.